All right, everybody. Welcome to Discovering Multifamily. I'm your host, Anthony Scandariato. And today we have a very special guest with us, Adam Riddle, who's the co-founder and principal of Nexus Commercial Realty, based out of the greater Denver area. And, he's has a strong focus on multifamily investment sales on both the sell side and the buy side. And there's a couple of particular areas where he wants to focus on. We're recording this in hopefully towards the tail end of coronavirus in terms of 1031 exchanges and just the overall state of the market. He's been involved with over 500 transactions worth of, in excess of half a billion dollars in multifamily. And he's dealt with all sorts of situations like HUD, triple net, seller carries. And he's definitely a creative person and a good person you want to know in the multifamily space, and want to welcome him to the show. So thanks, Adam, for coming on. We appreciate it.
Thanks for having me on. It's great to be back in the office for the first day in a while. So feeling good.
Awesome. Yeah, it's definitely good. So could you kind of tell us about your team and what you guys focus on pre-corona and what you're planning to do post-corona, and what are sort of what has the past couple months been in the greater Denver area for multifamily on both the buy side and the sell side? What does it look like?
Sure. So at Nexus Commercial Realty, like you said, we are a brokerage specializing in only two things: existing multifamily assets and land for ground-up development for mostly multifamily assets. We have an office here in Denver, and in Colorado Springs, we have 13 brokers that kind of work the front range of Colorado. We really specialize in kind of 1 to 15 million. Some people call that mid-market, small. Don't chase a lot of the institutional stuff. In our market, that tends to mean that we sell a lot of older product, kind of 70s, 60s, 50s is when a lot of that was built in Denver, at least. So yeah, we've been around this company for about 3 years. We were with another brokerage shop before that, and we love the space we play in because it's with a lot of private clients, whether it's their own money or raising money or syndicating deals versus kind of institutional. That's just a different ball game. Prior to COVID, we were setting on pace to set a lot of records. We had a really good start to the year. We had attended NMHC out in Orlando, annual kind of biggest event, and just didn't hear any negative talk, which there's always somebody or a person or two that's always like, the market's too heated, getting overpriced, are we overbuilding? And we hardly heard any negative talk at that conference. So we came back with to report to the team, just this is going to continue to go, guys. We need to get on the phones. We need to get in front of people and continue to do our thing. Obviously, that came to a screeching halt at the end of March. We had a significant drop in our active pipeline, but honestly, a lot of that has been, not a lot, but a good chunk has been rebuilt. So I think it was that initial gut reaction of just like, what's going on? Is the world coming to an end? I got to get out of whatever transaction I'm in the middle of. And I think people are kind of starting to poke their head back out, and we've been able to put a decent amount of deals under contract, introduce a few new deals to the market that are getting some good traction. So, Colorado's stay-at-home orders are all coming to an end. So we feel like we're hopefully trickling out of this, if you will.
That is awesome. So can you kind of talk about the state of the market and then the new deals you put under contract? And obviously you mentioned the deal size that you play in, and that attracts definitely different types of capital, whether it's just a high net worth investor or even a 1031 exchange. I'd love for you to talk about that a little bit with some of the new changes that happen in light of COVID, or you work with a syndicator like myself, or it's very different than institutional, typical 5-cap, Class A, multifamily, which in my opinion is going to get hit the worst during all of this. and it got hurt the worst, definitely in the last downturn. But you also made a good point too, that you came back from a conference and there was nothing negative said. And I think the reason is um, the space that you play in. There's such a housing shortage to begin with in this country as a whole that we'd still need that type of product that you focus on to accommodate those tenants in certain income brackets.
Sure.
So could you kind of talk about those few, I know I said a lot, but those few things that I mentioned?
Yeah, I'll start with the last thing. I mean, we call it workforce housing. Some people call it Class C product. We love the space because you can't build it. You can't, with land costs, construction costs these days, you just can't build it. You can't build, in our market, you can't build a $950 one bedroom. It just doesn't make financial sense. So there's a massive need for that housing for people that have good jobs. They can't buy a home, and then they can't afford a Class A or even Class B apartment building. So we felt, I was in the last downturn in the same space, and it got hit. It didn't get hit near as hard as the higher end space. Obviously, everybody got hit at some point or another, but didn't get hit as hard. And we're also lucky enough to be in Colorado, and we came out of the last downturn before a lot of people in the country did. So I mean, we were coming out almost 10 years ago already, where some people it took till 2011, 12, 13, and 2010. We've kind of seen an increase for over a decade. For kind of what we're doing now on deals, obviously there's less people calling in, but the ones that are calling in seem to be pretty serious about buying something. We're trying to make sure we're doing proper due diligence for everybody on the front end. Who's your banker? Let's talk to them. Let's make sure we're all in alignment on that. Obviously gaining access to units, making sure people are as comfortable as they can, trying to get inspectors, appraisers, everybody kind of coordinated to not be entering in units multiple times throughout the transaction process. Before this, people were definitely in our market aggressively pricing apartment deals. So I think we're in for a little bit of a reset on pricing, but that was probably something that needed to happen anyway. But it's interesting, the stuff we're putting out there that we feel like is priced in the right price range is getting eyeballs on it. It's getting activity and getting offers. Obviously, the next step of that, the inspection, the appraisal. We put a deal in our contract this morning, and we're already kind of working through the loan and the appraisal piece, because you just got to start that process almost even earlier than you ever have. So we're definitely on top of our brokers, saying the good old days where it's like, okay, almost every bank will lend on apartments because it's kind of the darling of commercial real estate. So whatever they pick is probably going to be just fine. It's like we have to be way more involved on the brokerage side. And to anybody that's out there buying, I would just make sure your broker is involved in every step of the way now more than ever, because it is key to keeping deals together, because just one small thing can make deals fall apart right now.
That's a really good point. So the deals that you put under contract, how has the pricing difference been from pre-corona to now?
Not a huge price adjustment. I mean, we were kind of 97% listing price to closing price pre this. Probably don't have a good enough data set to really understand what it is now, just because it's still so early in the process. But I can tell you, the ones that have, we had a couple of listings going into this that were just high to begin with, and we went back and said, if you want to sell these, you need to get realistic. They dropped the prices to what we considered what we should have listed them at to begin with, and then they moved at those prices. So we haven't seen a big drop in prices, 10, 20% or anything like that. And I've been on the phone a lot with people that are waiting for the 08, 09, 2010 bloodbath as far as pricing. I'm not going to say it's going to happen or not going to happen. I think if there's going to be deals like that, it's going to be in 60, 90 days once most banks, Fannie and Freddie did forbearance. If you didn't do that, most of our local banks gave you 90-day relief. and made it very simple. So I think anybody that was hurting went and got some relief for at least that 90 days. So if they are going to be hurting, it's going to be later on in the summer and in the fall potentially, but I just don't see it being widespread here.
Yeah, that's the sentiment that I've been seeing as well. Can you kind of talk about, what type of buyers that, and obviously you work with different types of buyers, but you play in the same space that I do. So in that 1 to, let's call it, 15, $20 million range. Can you kind of talk about the buyers that are already in the space, but the more type of buyers that are going to come out of, you could kind of come out on top. You're going to see more of once we get, once in Colorado, once the stay-at-home orders really get lifted, and what do you see is going to emerge? That type of buyer.
I mean, my business partner and I started our company 3 years. Some of our best clients today came from 2008, 2009, 2010. And they came from just having inventory on the market, and those people were raising money, saw an opportunity potentially in the market being that it was a downturn, and had enough kind of friends and family or network that had liquidity that believed in buying in at that time. So I think we were already seeing new buyers enter the market that honestly we just have not talked to before, whether it's out of state or just a local investor that's feels like there's a little bit of an opportunity to get back in. Maybe he's been out of the market for a little while. So I think there'll be a little mix of that. Some people that have been on the sidelines maybe have liquidity and have cash sitting there waiting that are going to see if they can try to, again, I don't think it's going to be these gigantic discounts, but maybe a little bit of a discount versus pre-COVID, and still believe in the market. And then there's just going to be people that understand the fundamentals of real estate, and everybody kind of needs a place to live. And we're going to come back out of this. I don't know when, but we're going to come back out of this and take a gamble. I mean, some guys that bought in 2009, they had a rough first year, 18 months, but then 12, 13, obviously they look like geniuses as far as the basis they were in at on a lot of those properties. So I think a lot of people remember that and are going to be ready to try to capitalize on some of that.
Sure. Yeah. And like you said, you haven't seen it yet. I certainly haven't seen a major discounts happen yet. A little bit, but nothing too crazy. So could you kind of talk about some, of the provisions that we've seen come from the federal government? So for example, I know for 1031 exchanges, they extended deadlines there and they pushed them out even further. Could you kind of talk about, if it makes sense if somebody was planning to sell, like let's say I had a 100-unit building, I was planning to sell this year, and I was like, you know what, it's still cash flowing. Well, let's just hold it until we're out of this mess. Is that a smart strategy, or would you say there's an opportunity with the 1031 market, still, with all those extensions once we're kind of out of this? What would you have to say on that?
Sure. I mean, obviously our suggestion is always sell if the timing is right for you. That's why we're still doing deals today, just because the timing's right for those individual people. But there was definitely a good chunk of properties that we were kind of working on listing or going to market for towards the end of March that just got completely halted. And what we're doing now is, with the recent extension on 1031 deadlines, we feel like there's going to be kind of a pent-up demand late June, early July, of all of these 1031 buyers that are kind of been given the opportunity to sit on the sidelines, given a longer deadline periods. And there's going to be a lot of pent-up demand in June, July. And we feel like we are going back to those people that we were talking to in March and saying, mid-May is not the worst time to be going out to the market, because there's going to be a lot of people that are going to have eyeballs on multifamily that still have to place their money. Obviously, you can still pay taxes, but still have to place their money and still would rather not pay taxes. And even the people we were talking to 2 weeks ago before they extended the deadline understood the financing conditions were rough and just willing to put more money down to make a bank more comfortable with it. And I think a lot of 1031 people are going to end up having to go that route instead of the 25, 75 leverage. They're going to have to put 35 or 40% down but they'd rather do that than pay their 30 or 35% on taxes. They can refinance when it all settles down and maybe pull some cash out. But I think there'll be a lot of pent up demand come June, July from all the 1031s that got extended.
That's very interesting. Can you kind of talk about your market in general in Denver, where you sit, and especially in the workforce space? Where do properties sell for generally for a C building? It doesn't have to be in Denver, but the greater Denver area. Colorado Springs, any of the other major cities. What do things on if they're at the upper end of the workforce, on the lower end, on a per unit basis, and kind of cap rates? What do like value add properties trade for, and what do stabilized properties trade for? I'm curious myself, and I'm sure my listeners are curious too.
Sure. I'll kind of hit four. I'll start with Capitol Hill, kind of central Denver, a lot of 20s, 30s, 40s, kind of classic architecture, 12 unit, 20 units, 24 units, higher rent, a lot of restaurant workers, a lot of very little parking, just, it's a central business, downtown vibe. Those are very expensive. They are trading anywhere from 170 to 250 a door for the mid-rise 60s product. An out-of-state investor just paid 250 and they're putting another 50 into it. Those are going to be kind of high 4, low 5 caps, even on the older product. You head east to Aurora. That's more of a workforce housing neighborhood. It's got a lot of kind of that mid-market buildings that were built. That's probably going to be kind of 95 to 115, 120, 125, depending on the location, the size, unit mix. More like 6.5 caps. Then you kind of go to our western suburbs, which there's a handful kind of out west that kind of align the foothills. And those are going to be kind of in between there. You're going to see anywhere from 140, 50 up to 200. Haven't quite beat the 200 market door out there. We are under contract on a couple of deals that are going to get real close, but they have 2 to 3 bedrooms, kind of very large units. So that's driving that price per unit up. Then Colorado Springs, which we're very active in, kind of always lags Denver as far as pricing and cap rates. We started working down there about 7 years ago, and that's just one of the most sought after markets, especially from out of state. You can get into the quote unquote Denver MSA almost, even though it's not that far away, but and just get a lot more pricing. I mean, you can buy a 6.5, to 7 cap down there, high 90s, 85 to 110 a door, again, depending on the size of the units. And there's a lot of large kind of 100 to 200 unit Class C properties down there. So it's a lot of California investors that they can sell it, a 10 unit in San Francisco and buy a 100 unit in Colorado Springs. So we have a lot of California money in the Colorado Springs market, for sure.
Makes a lot of sense. And so Adam, I guess kind of wrapping down the show a little bit, I guess what advice just would you have for both buyers and sellers, once we get out of this, just to be, like you said, just more cautious and to be more involved with your brokers, with your lenders, because whereas before, like you said, money was cheap. It's still cheap, but there's an influx of lenders. A lot of lenders pulled out, at least right now. Like what advice would you say? And I know you're not on the debt side, but is there a certain loan product that you're kind of advocating, just that it's still reasonable to get deals done and, in a timely fashion to your buyers or sellers?
I mean, obviously Fannie and Freddie were the big gorillas in the multifamily space for a long time, still will be going forward. With their requirements now, it's going to make it hard for some people, especially if you are raising money and offering prep returns and all that kind of good thing with the escrow requirements that they have. But you can get creative with those escrow requirements. I'm hearing some people talking to sellers about splitting some of that, or just getting creative to where everybody's got a little piece of that action and it's not just on the buy side. So don't be scared to try to get creative with that. You know, we did a lot in 08, 09, 2010 with our kind of local regional lenders. A lot of that's recourse money, so I get some people are not willing to do that. But those were the people that got us through on the brokerage side in the last downturn. They are going to be more conservative, obviously, but especially if you have an existing banking relationship or willing to move a relationship to them on the deposit side, our local lenders are the ones that are really pushing stuff through at the moment. So I would hit up, if you're looking at a deal in OK on the recourse side, I would definitely hit up kind of some of those local strong lender relationships with banks that are more on the conservative side, as far as, so they probably don't have a lot of bad loans, so that they're still willing to lend out money. And then just have your ducks in a row. I mean, if you're a buyer, I would just have my ducks in a row as much as possible going into a deal. You know, like I said earlier, one little thing can make a lot of hiccups. So I don't think we have to be in a hurry as much as we were. You know, 6 weeks ago, people were needing to underwrite in a day, present offers very quickly, tour as quickly as you can. I think that expectation has backed off a little bit. I think on the brokerage side, obviously prejudice, but we would rather somebody take their time and get the deal to the closing line than rush to get into something and then it blows up 30 days later because we didn't check certain boxes before we went into the deal. On the sell side, I mean, I think really being in tight knit with your manager, if you have a third party property manager, if you run your own property, just making sure you're on top of, you know, your collections and your repairs and maintenance. The buyer and or lender are going to really be scrutinizing things on that front. So the more answers you have, instead of, you know, they send you a laundry list of 15 questions and you got to scramble to go figure all this out, just the more you're on top of it in the beginning, the more you can just be in front of it and be ahead of it. I think the better. And obviously, you know, working with a professional broker that knows what they're doing, I think will help that process. Because that's what we're doing with all of our sellers, just making sure we're in front of every question. If there was, you know, a bad collection month, even 3 months ago, that had nothing to do with COVID, what is the answer to that? I think the magnifying glass is going to be coming out significantly from the buyers and the lenders at this point. So again, the more you can dive into that P&L, that rent roll, and really understand each line by line, that's going to help everybody in the long run.
Makes a lot of sense, Adam. Well, great. How can people find you? How can my listeners reach out to you and your brokerage team, and, you know, for them to learn more about not only multifamily, but they want to get into, they want to learn more about the greater Denver area, because it's been on my radar personally. I don't have any assets there, but how do people reach out to you and want to learn more if they're considering making an investment in Denver?
Sure. My cell phone, 303-257-7627. My email is ariddle, RIDDLE, at Nexus, NEXUS-CR.com. And our website is nexus-cr.com. So that has all of our active listings. We have an email list that we send all of our deals out to before we post them online. So happy to add anybody to that. Happy to talk to you this market or just multifamily in general. I've been doing this for 13 years. This is my blood these days. This is all I talk about. So even if it's not about our market, just about how to structure deals or approach brokers or look at anything, I'm just happy to chat.
Awesome. Well, thanks so much, Adam, for coming on. And we'll put a link to Adam's number, if he's okay with it, in the comments section, and a link to all his profiles and his website, so you can reach out to him or you can reach out to me, and I'll put you in touch with Adam. But I want to thank you again very much for coming on the show, and hope you guys got a lot of value out of it and really appreciate it.
Thank you.
Great. Till next time, this is your host, Anthony Scandariato, and look forward to having you on the show again in 6 months from now.
Sounds good.
All right. Thanks again.